Hitting that $1,000 mark in monthly dividend income is a pretty exciting milestone. While it may not be enough to retire on just yet, it's a great step in the right direction. Thanks to the power of compound interest, you might reach your financial goals even sooner than you think. Earning $1,000 a month can definitely make a difference in your finances, giving you that extra boost of motivation to keep growing your investment portfolio. Before you know it, you could be well on your way to living your dream lifestyle and retiring comfortably. But the big question is, how much do you need to have invested to consistently bring in that $1,000 every month from dividends? Let's break it down. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. The first step is picking a dividend yield that balances growth, income, and stability. High yields might seem appealing, but they can come with risks. For example, a stock yielding 12% could have a declining price or unstable dividends. A safer range is typically between 0.5% and 5%. Many investors make the mistake of chasing overly high yields, which can indicate slow-growing companies or risky dividends. High dividend yields often carry risks. A high yield may indicate slow growth, as seen with AT&T, which offers a 5.1% yield, but has seen its stock price decline for years. Alternatively, dividends may be at risk of being cut due to weak performance. Thorough research is crucial to avoid these pitfalls. While investing in individual dividend stocks can provide higher yields, it also comes with unpredictability. Poor performance or dividend cuts can lead to losses. Timing can be profitable, but chasing high yields frequently results in disappointing outcomes. If you're after a hands-off investing approach, dividend ETFs like Schwab's SCHD are a solid, low-risk option. This fund mirrors the Dow Jones U.S. Dividend 100 Index, featuring companies such as Home Depot, Texas Instruments, and BlackRock. With a 3.3% dividend yield, an investment of around $400,000 would bring in $1,000 per month in dividends. Plus, these high-quality companies are expected to keep paying and even increasing their dividends over time. If you're looking to boost your returns over time, growth ETFs like Vanguard's VUG might be the way to go. This fund focuses on large-cap growth stocks such as Apple, Microsoft, and Alphabet, which provide minimal dividends, only 0.44%. To achieve $1,000 per month in dividends, you'd have to invest around $2,750,000. Still, the growth potential of these stocks typically outpaces that of dividend-focused investments, making them a more appealing choice for long-term gains. For those seeking a mix of growth and income, investing in an S&P 500 ETF like Vanguard's VOO is a great choice. It gives you exposure to a wide array of companies, including leading tech firms and financial institutions. With an average dividend yield of 1.31%, you'd need around $920,000 invested to generate $1,000 per month. This option strikes a balance between moderate income and growth, ideal for investors who want a straightforward investment strategy. Sector-specific funds, such as those focused on real estate or energy, can deliver attractive dividends. Take Vanguard's Energy ETF, VDE, for example. It boasts a yield of about 3.5%. To pull in $1,000 a month, you'd have to invest roughly $350,000. That said, it's important to recognize the risks involved in these funds, particularly the possibility of decreased oil demand affecting energy investments. A smart investment strategy is to focus on growth in the early stages of your career. In your 20s, 30s, and 40s, dividend income often isn't relevant unless you plan to retire early. By concentrating on growth-oriented investments, you're likely to achieve higher annual returns than those who emphasize dividends. Even a small edge in returns can compound significantly over time, setting you up for a stronger financial future and greater wealth in the long run. As you approach retirement, prioritizing dividends becomes essential. In this stage, income stability, safety, and capital preservation outweigh the need for growth. A thoughtful dividend strategy can offer a more secure alternative to high-risk growth investments. Your retirement timeline is a key factor in deciding between growth and dividends. If retirement is still years away, focusing on dividends too soon could cost you significant potential growth. While dividends may seem like the ideal passive income, remember that rising share prices are the main driver behind your portfolio's growth. Striking the right balance between immediate income and long-term growth is vital for a comfortable retirement. By focusing on a balanced approach, you can not only reach that $1,000 monthly dividend goal, but also foster long-term growth, ensuring your financial security as you move toward your financial independence.